Hello world, my name is Ara. I'm a full stack developer with a passion for investing and teaching. So today I'd like to talk about options, but before I do, I'd just like to say that options are not for everyone. They are very risky, and many people can and do lose 100% of their money by investing in options. But that being said, the reason why some people do invest in options is because you can make 2,000% on your money in a very short time frame. So this is a how-to video, not an advice video. So first of all, an option contract is a contract giving you the right to buy 100 shares of common stock in a certain company. There are call options and there are put options. I'll be talking about call options, meaning if you own the contract, then you want the price of the stock to go up. So there are four main factors that affect the price of an option contract. First of all is strike price. If I am buying a short-term option contract and the share price of Facebook is currently $155 a share, and I choose the strike price to be $145 a share, then I can expect the option contract to cost slightly more than $10. So if Facebook is $155 and I choose $140 strike price, then I can expect the option contract to cost slightly more than $15. Now every contract is for 100 shares, so that would be not $15 cash, that would be $15 times 100 because it controls 100 shares of stock, so that would cost $1,500 for that one contract. So those are examples of in-the-money options. An out-of-the-money option would be if you choose a strike price like $160, $170, $180. You're expecting the stock to go way up, but you're taking a big chance that the stock never ever reaches that strike price. So those would be called out-of-the-money options in those examples. Obviously, because they are far less risky to make money, those options cost much less. The second thing that affects the price of an option contract is the time until expiration. If I choose the options that expire on June 30th, 5 days from now, a $150 strike price costs $5.35 right now. So times 100, that's $535. Now, if I choose a $150 contract that expires in 18 months, 572 days from now, January 18th, 2019, that same $150 contract will cost you $24.10 or $2,410. So, obviously, options contracts cost much more money the longer out you go. And rightfully so, because you have a far greater chance of the stock price to hit your desired target by that time, the longer out it goes. The last two things that affect the price of an option is volatility and interest rates. I won't be talking about those in the course of this video, but to quickly talk about volatility, just to give you an idea. A stock like Amazon that goes like this, the options on that stock would cost much more money than the options on a stock that hardly ever moves. So I would quickly like to talk about just a particular option as an example of Facebook. So let's say you wanted to take a lot of risk and you wanted to choose an out-of-the-money option on Facebook. Let's say you wanted to choose an option, let's see, a strike price of $160, so about $5 out of the money. This option is trading very inexpensively because it's very unlikely to be worth anything by the time this option contract expires. Right now it's trading for 11 cents. So that would be $11. If you were to buy 40 of these contracts, that would be a $440 investment, give or take. There's always the fees, the trading fees, which are about $5 to $10. So let's say it's a $450 investment. So this $160 strike price contract, let's say Facebook goes up to $163 within the next 3 days, and you are jumping up and down, jumping on the couch, screaming. You are so excited because now your $160 strike price contract is worth $3 because Facebook is trading for $163. So you paid 11 cents for the contract, and now it's worth $3. So if you bought 40 of them, you would have spent $440, but you would be able to sell them for 300 times 40, which is $1,200. I'm sorry, $12,000. I had to think for a second. I was like, wait a minute. That's not making $10,000 in one trade. Okay. $3, which is $300 times 40, that would be $12,000. So you could buy them for $440. You can sell them for $12,000, giving you a net profit of $11,560 minus trading fees. So maybe $11,540 in one trade. That is incredible for a $440 investment. Now, the reason why most people don't do this is because Facebook is unlikely to get to $160 a share in the next few days. It's only $155 right now. To jump up 3% in 1 week is abnormal. It does happen. Sometimes Facebook does go up $5 in a week. Sometimes it goes up $10 in a week. Who knows? Sometimes it goes down $5 or $10 in a week. But this is unlikely to happen, and that's the reason these options are only trading for 11 cents right now. But if you're willing to take the risk, and it does go up big time, this is the way to make $10,000 in 1 week.